Hello everyone, welcome back to the seventh stream. So this is the seventh out of 8 days that I study for chef CFA exam. Yeah, we're back and wrong fucking. Okay, there you go. It's the correct one. Yeah, I can't see chat. Yeah, it's fine. Okay, I'm gonna show my Gemini. This is where I ask a lot of questions, like something that I don't understand. As in a PowerPoint, I'm just gonna ask Gemini, like, what, like, can you elaborate more? Can you like give me example and stuff like that? So, yeah. I'm sorry, I'm definitely not gonna look at chat. Like, like yeah. I think I'm just gonna, I'm gonna put like a text. Okay, yeah, let's go. Um, Everything is should be prepared soon. Okay. Okay. I use pro. Fuck, it's fine. tax term for tax return. There is a lot of stuff here. Tax returns for tax return. There is taxable income, taxable payable, taxes payable, income, tax paid, tax loss carry forward, and tax basis. So less tax-based income is the amount of income subject to tax based on the tax return. Actual tax liability for the current period based on taxable income paid tax. Actual cash flow for income taxes, including payment or refund from other years. Tax loss carry forward. Current or past loss that can be used to reduce taxable income, thus tax payable in the future. It can result in deferred tax asset. And tax basis net amount of asset. Okay, tax term from financial reporting. Accounting profit pre-tax financial income based on financial accounting standard, also known as income before tax and earning before tax. Income tax. Flippy disk. Okay. I'm not connecting with the material at all. So I think what I should do is try to get some kind of connection. I get it. It is good for analysts to learn this. Because it creates temporary differences, and like there's like also some cases where like you can change if a company has a DTA, but it's unlikely they will no. I read somewhere, but like you like apa namanya, perusahaan like a company can change their taxes completely. Adam, but okay. Yeah, I'm just some kind of connection. I'll just read one example, okay? Flipdisk Corporation purchased an injection molding machine for 30,000 at the start of the current period. The machine has a useful economic life of 6 years and no expected residual value. For accounting purposes, the machine will be depreciated straight line. However, a double decline balance will be used by the tax authorities. Calculate depreciation for accounting and for taxes and discuss the timing difference. So this is the answer. The accounting depreciation is 5k, 5k, which is like cumulative fee, that, and then, but for tax return depreciation is different. The first is going to be 10k, the second is going to be 6.6667, 667, 30, 4, and etc. etc. It's going to be different. The total amount of the depreciation over the life of the asset is the same. The accelerated method used in tax return in more depreciation in the early years of the asset life, but less in the later years relative to straight line method. Visually, we can see that the tax return depreciation is greater in the first 2 years, creating a timing difference, which then began to reverse from year 3. But due to temporary timing differences, taxable income will initially be lower than earnings before tax, and account. The result of this is that Flippy pay lower tax in year 2, year 1, and year 2. Due to temporary timing difference, taxable income will be initially lower than earnings before tax in the account. Due to temporary timing difference, the taxable income will be initially be lower than earnings before tax in the account. The result of this is that Flippy pays lower tax in year 1 and year 2. I'm guessing it's because tax certain depreciation. Once the tax certain depreciation drops below the accounting depreciation, taxable income will be greater than earning before tax, and Flippy will pay more tax. The temporary timing will difference created and then reverse, resulting in less tax due to in the early years and more tax due to in the later years. We know with certainty that when the timing difference reverse, Flippy will pay more tax, meeting the definition of the liability. A DTA is created when tax payable tax returns are greater than the income tax expenses. Nice. Similar to DTI, you said. A DTL means you are reporting higher tax expense to your shareholder today than you are actually paying the government right now. You are saving on taxes today, but you are reporting higher tax expense to your shareholder today than you're actually paying to the government right now. Okay? You are saving on taxes today, but you will have to pay the money back in the government in the future. You have to take a big tax deduction now that isn't yet recognized on your official statement. Oh my god, I can't wait. A DTA is the opposite. It means you are paying more in taxes to the government today than the official expense you are showing in the shareholder stuff. You have prepared some of your future. Okay. Summary. Oh fuck. Current status: paying less tax now, paying more tax now. How about this? Well, I should add cash flow as well. That's fine. I forgot the Pomodoro timer, bro. I'm a little bit regarded in this. Okay, to understand the difference between DTL and DTA, it helps to look at this as a timing gap between what you sell, what you tell to shareholder. I already understand that, but like, what does it mean paying higher? I think it mentioned as well in the PowerPoint. Is created when tax payable are greater than income tax expense due to temporary differences. Similar to DTA, taxable deduction, temporary difference. Okay. So, Okay. A DTL is occurs when your income tax expense, which is in the for the shareholder, for the is higher than tax payable. Okay. Example, depreciation. A company buys a machine for 40K. Accounting uses a straight line, which is like 5 years, so like $8 the first year, $8 the second year, and until the 5 year. The government allows accelerated depreciation over 4 years. Okay, so in accounting, in an income statement, it's going to be 8K, but you pay the government like 10K in the first year, so it's different. I think the PowerPoint is also, yeah, in a PowerPoint, see, the first years in the accounting depreciation, you put 5K, but you have for the government, yeah, okay. Your tax return shows $2 more in depreciation than your financial statement. Because you have higher deduction on your tax return, your taxable income is lower and you pay less cash to the government today. What the fuck does this mean? Balance sheet. Your tax return shows $2K more in depreciation. Then your tax return show okay. Because you have higher deduction on your tax return, your taxable income is what is, and you pay less cash to the government today. Okay. So you have higher deduction over your taxable income. Yes. Okay, in the balance sheet you record a DTL of 6. This represents the tax you save today, but will eventually have to pay back in 5-year times. But okay. Actually, it is the exact opposite. In deferred tax liability scenario, you are showing a big tax bill to shareholder than you are paying the government right now. Think of DTL as a taxes. I guess sebenarnya sih karena kan liability kan ya, so you kinda owe someone more than you actually is. Like you owe someone, right? So Makanya you owe the government. I think ngeliatnya perspektifnya sebagai ini, lu punya shareholder, lu punya government, like lu, tapi misalnya di tahun pertama lu malah ngasih 10.000, oh my god banget. Oh oke. Next, nah kadang-kadang kan karena lu bayar kelebihan, kalau kelebihan itu aset ya kan, deferred tax asset, tapi kalau lebih kecil liability, that means it's called deferred tax liability. Is that what I'm guessing? Okay. As tax discount you get today that you have to pay back later using the numbers from the flippy disk example, slide 6. This is actually break down. On a tax return, the government, you claim 10,000 in depreciation. This is a massive reduction that makes your taxable income very small. On the income statement, you only claim 5K in depreciation. This makes your official profit looks much higher, or how it hits the books. Sorry, if we assume a 30% tax rate, look at the difference in tax amount. Tax for a DTL, you might show 10K in tax expenses on your income statement, but you only pay 8K in cash. So I have to pay the government 10K, but I only pay 8K. So I have 2K, where like I have to pay in the future, right? The result, you record deferred tax liability on your balance sheet for 2K. Okay. When the bill comes due, eventually the magic of accelerated depreciations run out. Let's look at year 6. Yeah, it costs the same, right? Tax certain depreciation 3.651. Accounting depreciation is still 5K. Now the table have returned. Your tax deduction is smaller than your accounting expenses. You will now have to pay more cash to the government than what you show in your income statement. You pay that IOU DTL is extra cash. Summary of DTL current period income statement. Oke. Gue agak ngerti sekarang. Gue pengen ke toilet. Okay. DTA occurs when revenue or gains are taxable before they are recognized in the income statement. Expense or loss are recognized in the income statement. Tax loss carry forward. Taxable deduction and temporary difference. Another way of analyzing temporary difference is to compare the balance sheet carrying value of the asset and liabilities to their tax base value. Comparison of carrying value to tax base for temporary timing differences. So in the balance sheet, as asset, that's liability, right? So carrying value. Tax base. What is the carrying value? Deferred tax liability, deferred tax asset. Wait, deferred tax liability, that means what we pay the government. What is carrying value in slide 9? The carrying value is historical cost minus accumulated depreciation. If the carrying value is bigger than, okay, so for example, tax base. Can you give me an example as well? On slide 6, the carrying value represents the machine value. Okay, I'm guessing depreciation-nya kan ini semuanya jadi 35. This is the carrying value-nya di tahun pertama itu 35.000, ya kan? Tapi tax base, I'm guessing it's nggak, sorry, 25.000, but it's actually 20.000 yang kalau yang di tax certain depreciation, karena carrying value is bigger than tax certain depreciation. I don't know what the fuck it's called, but yeah. So what happened is, this is on year 1, year 2, apa namanya, carrying value is bigger than tax base. Okay. Accounting depreciation, straight line 5k is 25, carrying value is 25. Okay, yeah, 20, etc. Right, the gap, 3 in this case of 5. That is 5k, it's carrying value, and I don't know what the fuck it's called, but there's 5k. And this 5k is gonna be carrying value bigger than tax. So this is gonna create DTL, right? DTL, it goes on the asset and the liability. It's gonna be DTA, yeah, the for tax asset. And in year 2 is gonna be 20. It's probably gonna be around so I'm guessing, and in year 6, in the balance sheet, gonna be DTA in asset and DTL in liability. I hate it, one thing. Year 6, the timing gap has come. Oh fuck, year 5, so I'm guessing in year 4. Okay. The result, in the early years you create DTL because you paid less tax than your profit suggested. So yeah, in the final state, year 6, yeah, okay. Why don't they usually sit on the balance sheet together? For a single asset, it is one way then back journey. DTL content. The netting rule. In a real company full financial report, you might see both DTA and DTL listed in both footnotes, but on the actual balance sheet, they are usually netted as a single line. Yeah. Oh, okay. A net deferred tax liability. Okay. The analyst red flag. If as an analyst, you should watch the trend of that DTL. If the DTL keeps growing every year, the company is constantly buying new asset and delaying taxes. Buffett actually view this growing DTL as an interest-free loan from the government. As long as the growing company keeps growing, they may never actually have to pay back the full bill back. Interesting way to look at DTL. Yeah, it's like a apa namanya? Yeah. Okay. Well, it's ya karena DTL grow, karena berarti kan lu ngedelay paymentnya dari lu ngedelay payment taxes to the government. Okay. The permanent difference between taxable income and preferred tax. Okay. With taxable income, I so wait, the certain taxable taxes payable. Fuck it. A permanent difference between taxable income and pre-tax income is one that will not averse in the future. Permanent permanent differences do not create DTAs or DTLs. Permanent difference can be caused by revenue that is not taxable, expense that are not deductible. Okay. Okay. What do analysts think about tax payable and tax expenses? I'm fucked, yeah. Am I back? I should be back. Okay, that's back. Analysts view the gap between taxable and taxable as a window into a company earnings quality and its future cash flow stability. While accountants focus on making balance sheet and analysts treat this number as a clue about management optimism, the sustainable of profits. Analysts are often skeptical of deferred tax asset because they represent a hope for future tax saving. Okay. Analysts look at DTLs, but differently. Has to be paid back. Essentially, it has an interest-free loan from the government that increases the firm value. Comparing the three tax rates to understand the real tax burden, analysts reconcile three different rates found in the footnote. Analysts use tax rate reconciliation to forecast future earning. They look for continuous versus sporadic items. Okay. I'm not gonna go here. Okay. Change. Okay. Creation or increase in DTL, increase tax expenses. Creation of increase in tax. Okay, so tax expense is better way to say it. Okay, here's another example. Deferred tax and deferred liability. Deferred tax liabilities. Firebird Corporation is a new subsidiary set up at the start of the year by its parent company, Wraith Incorporated. Okay. Firebird statutory tax rate is 30% and he has no permanent timing difference. Tax return and income statement are presented for the first 3 years of its operation. So tax return, Firebird Corporation, okay. Revenue, cost of sale, other expenses, depreciation, interest expense, taxable income, tax payable 30%. Gross property depreciation. Warranty costs. Depreciation sama warranty cost digabung. No. Oh, this okay. Firebird acquired PPE for 40 millions at the start of year 1. For financial statement reporting, the PPE is depreciated straight line over 5 years, while for tax reporting it is depreciated straight line over 4 years. Its residual value is assumed to be 0 in both cases. Firebird estimate that warranty expense will be 5% of gross revenue. For this example, we will assume all of the year-end liability value for warrant are likely to pass. Oh yeah. But analyze the difference between tax return and the income statement and calculate any deferred tax item that Firebird will recognize. The first noticeable difference is the revenue figures. Remember that the revenue is reported net of any returns and allowances in the income statement. The tax return has a line for warranty costs, which indicates that these two may be the source of some of the differences in the significant between the two are the depreciation. Finally, yeah, the depreciation is like different, and the tax is like this. Okay. Okay. First break. It's been 38 minutes. Oh my god. I stopped that. Okay. At least I get to the 13th slide, which is not bad. Tax level depreciation. Okay. So I'm guessing the next slide we can learn about how it is actually created. What if I do this? It's too loud. Yeah. I'm gonna make it stay like over here. Should be good enough, right? It's not that high. It's a good amount of speech. It's a good amount of decibel. Pretty sure. Yeah. Let's go. Next we something called the timing difference related to depreciation. The tax allowance depreciation is 40k. Oh yeah, this is the example of that one. In total, 40 million of depreciation will pass through the tax return and the income statement. A different amount will be reported for each individual year. Depreciation will be higher in tax return than in the income statement for each of the first 4 years. Firebird will recognize a DTL because the firms pay lower tax initially and higher tax on the reversal on the timing differences. We may also say asset carrying value is greater than its tax base, resulting in a DTL. I have a question. Where does that come from? I made an analogy. Where is the amount of money is transferred It's very common to point of confusion, but depreciation, where to find the transfer of money. The actual transfer of cash from your business to the government is found in 3 different places. This is the actual transfer. This is the only place that shows the real physical movement of money. It is labeled as income tax paid. This figure includes the actual cash that left the company bank account during the year to pay the government. The balance sheet, the year end, and you still owe the government money for that year's profit. It's still if the year end and you still owe government money for that year's profit, it sits on your balance sheet as tax payable. Yeah? This is current liability. Represent the bill you haven't paid yet. In the income statement, the reported transfer, this show income tax expenses. This is the total cost of taxes for periods, which includes the cash you paid plus any changes in your pay later DTL and DTA account. Why depreciation is not the taxes? Okay, I was just thinking about that, but okay. Now let's start to connect this with the material, right? And that is yeah. What is the difference between I'm guessing I understand tax payable. What is this like tax payable and tax base? I'm not sure this. Tax base and carrying value. A bit EBT win. Oh, that's right. Okay. Okay. The tax return for the government. Okay. Tax payable is the dollar amount representing the actual tax liability you owe the government for the current period. It is calculated by multiplying taxable income. By it lives with the current liability, logic, it is the legal invoice. Okay. Carrying value, accounting reality. Carrying value, also known as book value, is the value of an asset or liability as it appears on your official balance sheet or shareholder. It follows accounting rule like IFRS or US GAAP for asset cost minus settlement. Tax base is tax reality. The tax base is the value of the same asset or liability but calculated by using government tax rule. For the asset, the amount that will be deductible from taxes in the future, for example, cost minus actual tax deduction. Liability to carry. How they work together. The difference between carrying value and tax value create timing gap. Temporary differences when it relates to DTA. Reduce tax expenses. Summary, if a company has a machine with a carrying value of 32 and a tax base of 30, they will have 2K difference. If the tax is they record DTL of 600. If the actual bill the government tax payable is okay, I kind of said. I don't think it is. I don't think it affects. Oh, really? I'm wrong. Again. Before the matching research. Accrual aims to show the economic reality that provides the tax content. Yeah, because like you predict the future, which is why I hate it so much. Okay. A warranty is a commitment to replace or repair goods if it's become defective during state warranty and period to current process. Sales. The financial statement accrual. You estimate 5% of your sale will be need to repair. You need to record a warranty provision as expense today. But no one has brought a broken product back yet, and tax and cash. The government generally refuse to give you a tax break on the estimate. They only allow you to deduct warranty expenditure once you actually spend the cash to fix all the good. Yeah, I don't get this anymore. Because you are recognizing loss on your profit statement before the government lets you use as a deduction, you end up paying more tax to the government today than your reported profits because you should. So the current result, tax payable, the tax return is higher in income statement, bigger than income statement tax expenses. Since you essentially prepaid some of your future taxes, you use a DTA on your balance sheet. This is your coupon to pay like taxes, because to pay less in the future when the repairs actually happen. Give me a second. When you buy the product, you put like a warranties. I don't know how to say it. Warranty expenditures once you actually you put a warranty provision as an expense today, even though you know it's actually bought a broken product. Yeah, right. When you buy the product, you get a warranty provision. In the financial statement, I'm guessing in the income statement, the part of the warranties, right? That's what I guess. And the government generally refuses to give you tax breaks on estimated expenditure. Okay. Because you record higher expenses, because you are recognizing a loss on your profit because this is an expenses, right? But the government lets you use as a deduction, you end up paying more tax to the government. Before the government lets you use as a deduction, you end up paying more tax to the government today than your reported profits suggest you should. Okay, current result, tax payable, tax return, more than percent. Since you are essentially prepaid some of your future taxes, you record DTA on your balance sheet. The math from slide 18. Okay. Warranty? What the fuck is warranty liability? Oh, I'm guessing it's 5. Okay. That makes sense. Yeah. Okay. The tax base of a liability is carrying value less than money passed to future direction. There is one exception to this, which is any form of revenue received in advance. Okay, this recall that we have assumed all of the year-end liability value for warranties are likely to pass through future tax return and expenditures incurred. This results in zero value for the tax base in each year, right? The carrying value. Okay. Okay. So confusing. DTA? Make. Okay, bro. Temporary versus permanent defenses. In the exam, you test ability to distinguish between that reverse and those that don't. What happened to your balance sheet if the government changed the tax rate? Existing DTA must recalculate using the what? It's more likely than not that the DTA won't be used due to the lack of future profit. It must be reduced. USGP use valuation allowances contract. I've never. What the fuck is this shit? Is the timing difference going to result in me paying more or less in tax in the future? You can answer those two if you edit that. Yeah. Is this an asset or a liability? I still don't get warranties. In warranties, apa sih nggak ngerti ya? What the... Okay. Okay. I am lagging. The fuck? Ih, sakit. Let's try to answer all of this question. Which of the following difference between financial reporting and tax reporting will most likely result in the creation of deferred tax liability? DTL, that means you owe the government more. Earning interest on municipal bond that is tax exempt, recognizing warranty expense on accrual basis, using straight line depreciation for financial reporting, and accepted depreciation for tax reporting. I like C is more correct. I don't know about A. Earning interest on municipal. Probably not. Okay. X. Floppy Drives Corporation purchased an injection molding machine for $50,000 at the start of the current period. The machine has a useful economic life of 5 years and no expected residual value. For accounting purposes, the machine will be depreciated straight line. However, this is for 5 years. Yeah. However, accelerated depreciation will be used by tax authorities resulting in year 1 tax return depreciation of 20k. I'm just gonna continue studying. However, accelerated depreciation will be used by tax authorities, resulting in a year 1 tax return depreciation of 20,000. If the statutory tax rate is 25%, what is the deferred tax DTL created at year 1? Okay, because it's 5-year period, right? And it is 50, that means in the account, in the depreciation is going to be 10k, right? And we have to pay 20k because the return on depreciation, I don't know, because it's like we have to pay 10k, right? So the resulting is going to be 10k in excess, 10k times 25% or 1 divided by 4, which is 2,500. So it's A. Phoenix Corporation is a new subsidiary set up at the start of the year by its parent company. Phoenix statutory tax is 20% on its first year. Phoenix reported revenue is 200,000. The company estimates that tax warranty expense will be 4% of the gross revenue, 4% of the gross revenue for financial reporting. This is revenue is 200 and the 4%. Let's start with the 4%, it's gonna be 8k. Yeah, 8k. However, actual warranty expenditure incurred allowed tax purposes year 1 was only 3k. Assuming all year and warranty liability will pass to tax return, what is the DTA? Okay, so it's 8k minus 5k. So it's 3k. It's actually 5.000 kali 20. So apa namanya, 5.000 dikali 0,2. Answer is 1k, and it's gonna be B. Okay, according to the relationship between balance sheet carrying value and tax base value, which of the following scenario resulted in a DTA? Okay. An asset carrying value is greater than its tax basis. Asset carrying value. Sebentar, gue mikir dulu. This one is gonna create DTL because the carrying value is bigger than what you pay to the government, like the tax base. That's what I'm guessing. And that means because the carrying value is bigger, that means you owe the government the rest, or like the carrying value minus the tax base. A liability, it is an asset as well, right? So, wait, no. An asset, okay. A liability carrying value is less than its tax basis. I'm guessing it's a liability carrying value is greater than its tax basis. Okay. For the current fiscal year, a company reported tax payable is 15k on its tax return. During the same period, it is DT. I just blank out. For the current fiscal year, a company reported tax payable of 15k. DTL is 2. It's B. DTL, no, salah gue. It's A, sorry. A company currently has a DTA of 4k on its balance sheet, originally calculated using a 20% statutory tax rate. If the government announced a neck increase in statutory, so I'm guessing B. So we increase DTA and decrease income tax expenses. Write off DTA direct to the equity, offset other derivatives. Create a valuation allowances which reduce the net balance sheet. Permanently reverse the temporary difference on the income statement. I don't know. I don't know this answer. It's I'm gonna guess A. A vintage distribution company does business in its home country and abroad. The statutory tax rate is 25%, but the effective tax rate for the current year is 21%. The statutory, okay. Analyst is reviewing the company tax rate, reconciliation table, and forecast future cash flow. Which of the following items will most likely explain continuous downward adjustment to the effective tax rate? A one-time tax holiday capital gain realized bonus, massive one-off sales, corporate estate. Oh, okay. Which of the following? Okay, explain continuous downward adjustment of the effective tax rate. One-time tax holiday granted by foreign judiciary. A lower tax applied on ongoing foreign operation. Capital gain realized on a massive one-off sales. Capital gains realized on a massive. I don't know. I know this one. This one is B. Okay. KCCO disclosed as its deferred tax and put not to its financial assessment. The DTA balance is 40 million when initial tax. TL is 600 million during the year. Management decreased the valuation allowance to the DTA by 40 million. They most likely affect the decrease in this year reported earnings for this year. So it decreased valuation allowances applied by DTA. So I'm guessing the DTA is gonna get lower. Because DTA get lower, that means tax expense will be higher, right? That means the earning will decrease. There's a reduction in valuation allowance, increase income tax expenses. What okay? I've never done, but okay. 1 is C, I'm correct. 2 is A, 3 B. 4 is wrong. Okay. 4 is C. Let's review that later on. 5 is A. 6 is B. 7 is C. 8 is wrong as well. B. 9 is B. 10 is, I have to check, 10 is A. I got 4 wrong. That's S. Let's see. 4. Okay. When asset carrying value is not tax based, by liability carrying value is tax based. Yeah, it's between B or C, so I did not understand this. So, but let's think about it. Okay, why am I wrong here? Liability carrying value is less, greater than this tax cases. True. Yeah. This is like kind of the same. Wait. Yeah. Okay. Yeah. 7 is there is no sufficient doubt that the benefit DTA will realize due to its legal losses. The firm must create valuation of allowances. Oh wow, I didn't know that. Okay. Yeah, because I didn't fucking read, bro. 8 is B. I answer C. 8 is vintage. Yeah. Okay. Wait, lower tax rate applied ongoing for okay. Wait, okay. Okay. And last one is 10 is A. 10 or the answer. I answer B. Really? Wait. Tax expenses equals DTL minus DTA because DTA, the fuck? Decrease the valuation allowance applied to DTA for the million. What is the most likely effect? I'm gonna take a break after this, like 15 minutes. It's actually the opposite. When the valuation allowance decreases, the net DTA on the balance sheet gets higher. Okay. Oh my god, this is so hard, bro. Higher accounting. Okay. Okay, I'm gonna take a break. Yeah, this is fucking hard as fuck. But I'm still gonna continue to the next. I don't like what the couples that kayak slide yang dua pertemuan terakhir. It's not my type of time that I do. I don't like this. The next slide is financial reporting quality. So this could be fun. This could be fun thing that I learned. So okay. Okay. And okay, yeah, this is the like I don't like this kind of stuff like taxes and stuff. So I like math. I like learning about useful stuff. Or, math is not really useful, but like interesting stuff. But yeah, okay. That is it. I'm gonna take a break. See you in a minute, I guess. I'm gonna take a 15-minute break. Yeah. Starting from now. Bye bye. I changed my mind. I'm gonna take a break for like 2 hours. My mind is not prepared. I'm gonna buy a coffee so I can like be more focused. So this is gonna be part 1 dari part 3 sih stream di hari ini. Streamnya yang gak lama sih karena demi I'm not interested in the material at all, susah banget materinya. So gue bakal stream lagi ya palingan jam setengah 2 gitu lah. I'm gonna next material what I'm gonna run is something called financial reporting quality. So yeah, this is for the stream. See you in like 2 hours. I need to sholat, makan, and